Life moves fast, and so does your career. You've built a successful path, but now it's time to diversify your investments and secure your financial future. Introducing The Prestige, your trustworthy, vetted partner in commercial real estate investing. We understand that you're time-starved with a family to care for and a demanding career to navigate. Not only sheltering, but safely multiplying your returns in a hard asset, which does not walk away. You can drive by it anytime. At The Prestige, we specialize in serving professionals like you who seek safe and secure investments without the burden of becoming an expert in commercial real estate. With over 400 years of combined experience, our team of seasoned experts is here to guide you towards high return, high yield investments in a low yield market. We meticulously analyze market trends, assess potential risks, and identify lucrative opportunities, ensuring your investment portfolio is optimized for growth and stability. Here's a few of our client testimonials. Wow, DL, this is so exciting. I'm so happy for you and for us. Very exciting, and love the floor plans. We've got our distribution pending in our bank account. Thank you so much, DL. DL, we can set our watch to your distributions. Never missed a payment. Don't let time constraints hold you back from maximizing your investments. Visit The Prestige at mayhill.com today for our current and rare investment opportunity, and let us leverage our expertise to secure your future. DL began in commercial real estate in 2005 and is one of the top seasoned leaders in investing and developing in Southern California and Dallas, Texas. And there is no slowing down. The Prestige, your partner in commercial real estate investing.
I could send some of that our way. That'd be appreciated. But I'm glad to be with you guys here today. I'm glad to share what I've learned in the last 13 years about retirement accounts, investing in real estate. So just excited to be here.
Well, that's great too, because when we met in Dallas a couple years ago, and then we met up again in Austin, and whenever we attend the directed IRA events, I always learn something new. Now, I'm not an IRA expert. I'm a commercial real estate developer, but I like to find out about different ways that we can save tax dollars and save our money, shelter and protect, and grow our funds. And I was especially excited to know that directed IRA has flat fees on the accounts. So we're going to go into that, because here's the thing is that most of the custodians will have your IRA account, and they will have, I don't know what they call them. They have flexible fees or whatever. I don't know what they call them. But at the end of the year, when your account grows, which is what we want it to do, then they charge more. They don't have to. It's just sitting there in the account. It's no extra work for them. It's not an IRS requirement either. But most custodians don't have flat fees. And so with directed IRA and with the code that you're going to get from Nate today, then you'll be able to invest with us, start with due diligence, but also work with Nate and with Ashley and save some money on your first account. And then get those flat fees on that account while we grow your investment account, your portfolio. So we're excited to have you here. The agenda will be a few minutes of the commercial real estate, 5 reasons. And then I also want to introduce, I'm looking for, okay, good. Warren is also on the Honors Way team on the construction side. So we have back office people here too, but Warren does planning and development services. He has 30 years as a planner in 2 different major cities. So he'll be speaking and giving a little bit of project update. And then we'll probably talk about 30 minutes. We know that you all are probably on your lunch break, and we want to honor your time. So I'm going to go ahead and get to it. Start that first little section. And bear in mind that we are not Zoom experts, but we are commercial real estate investor developers and IRA specialists. 5 things that you need to know about commercial real estate. And we're going to go a little bit fast because we have a lot of ground to cover. But if you want a copy of the slides, or if you want a copy of Nate's slides, then just request it. So this is probably the most important slide, is we want to pause and think about, what is your why? Why did you carve out time during your day to talk about commercial real estate and your IRA and your investment vehicles? So let's take a poll. Have you invested in commercial real estate before? Yes or no? And it's okay if you haven't, because we are beginning due diligence. You can't invest today. I don't have anything that you can invest in today. So you can take your hand off your wallet. We want you to focus on your dream. And do you want to diversify your income? Are you working and you want to diversify your income? Maybe you have a 401k from a previous employer and you want to translate that with directed IRA and our code honors 150, translate it into a self-directed, and then look at investing with us. Do you want freedom from your job? This is probably the most important slide, because it's your reason, it's your family, your spouse, your future, your time that you're investing now, or time that maybe you're retired and you're thinking, okay, well, I need to take a good look at my portfolio and see if it fits the age and stage that I'm on. As we get older, we have a risk factor that is different than a 30-year-old building their career. So we're taking time out of our day to really think about, from a high level, how to invest and why. My first property, I started out 20 years ago with 16 doors on my own. So now I'm building 350 units in Dallas. We talk about these kind of topics in our educational YouTube at honorsyoutube.com. You can learn about how to invest in commercial real estate, the market, the project updates. And I know that Nate has educational series that you can get involved with to learn about the different aspects of your investment vehicles as well. So we've got plenty of learning materials here. That's where we're starting. We're starting with due diligence. There is this hamster wheel, and I think that most of our investors are probably in this range, that they're working, they have very little time, and they want to make sure that they're working with experts in the field who will lead them in the right way and that will give them the right answer the first time. So that would be the majority of people that we work with. We are investing in commercial real estate. Our team has over 400 years of construction and commercial real estate experience. Warren is on the line right now, and we've got some of our investors who are invested with us already and have come in a number of times even. They've brought friends into the project. Warren, can you give a short, maybe a 3-minute update on the project and our accomplishments on the construction side?
Yes, good afternoon, everyone. Warren Ellis. GL said I'm on the team with the development services aspect of it. Just to bring you up to speed in terms of the added value to our assets, which is a little over 16 million. What we have accomplished so far is in terms of we finalized our unit matrix. Basically, we have a little over 13 ADA compliant units in our development that's been finalized. In terms of the easement coordinations, we have coordinated with various utility companies in terms of finalizing that, manage the relocations and documentations of the various easements that's going to be buried on site. As relates to our monument sign, which is the entrance, we have had bids and going to meet code compliance to verify that in terms of how we're going to install or develop the monument sign to show as the vehicle traffic goes by our development in terms of this nice monument sign for entry. In addition to that, building inspection, we have final approval by the building inspector as well as for our amenities building, the interior. We finalized the delivery layout of the documents as relates to that. As relates to our MEPs, which are mechanical engineers and plumbing, we've been working with our team diligently on that to make sure that all the mechanical, electrical, and plumbing documents are validated and submitted and approved by the city. In terms of for some of our interior, that we work with our interior designers, we have estimate costs for under cabinet lighting. We're working with that very diligently on that. So in terms of additional roofing and we finalize plans and estimate based on the storm drainage layouts and things of that nature. So we're very diligent working with our MEP as well as our architects as well as the city and finalizing a lot of the documentations for development to begin breaking ground and moving up in elevations.
Thank you for that. Yeah, I asked you to keep it a little bit high level and using lay language. So thank you for bringing it back a bit for us. But we do these project updates and we want you to know exactly what's going on. We do have 400 years of commercial real estate construction experience. So thank you for that briefing. Let's go back quickly and finish our section of the slide. So we've got architect, we have Kimberly Horn, which is the best civil in the state for our civil landscape architecture and environmental planning. So we're working also on getting that additional 5 acres of land for phase 2. We're very excited because it'll be $4 million an acre at the build. And that gives us, 5 acres times $4 million. That's a good chunk. That's what we're working on right now. So an additional value to that land. It's very, very cool, very exciting. Why multifamily? Well, I'm going to summarize this slide by saying it's not my favorite, but everybody needs a place to live. And Dallas is number 1 in terms of multifamily construction in the nation. And Dallas is number 2 in all kinds of construction. We have people moving in from all over the country to work in our high finance regions in Dallas, South Lake, and Plano. And everybody is moving to Dallas. So excellent place for multifamily. Our tenant type is also 30-something. They're not interested in buying a house. They're building their career, they're paying the rent, and that's the way we like it. Why Texas? I'm going to summarize this slide by saying Texas is one of the best places to invest. In February 2021, when I was speaking in Orlando, and we were coming out of the pandemic already, our tenants had paid rent because they're professional tenants. But people across the nation in Canada were still having issues there. They didn't have their traffic jams yet, and they didn't have the full restaurants and full retail yet, shopping centers. And we had all of those economic indicators already, traffic jams, full restaurants, full shopping centers. So Texas, but Dallas in particular, even over Austin and Houston. Houston's very soft. Dallas is the best market for multifamily and retail. Rents are higher, jobs pay more. So what matters most to you in an investment? What do you want out of this investment where we're going to work for you? And what do you want? Okay, let's get an answer to that poll. Thank you. Thank you, guys. Okay. Okay, so we talked about 5 things that you need to know about commercial. You're going to learn more than 5 probably. And if you don't get them, go to our YouTube channel, honorsyoutube.com. We must understand the asset class. This is Class A luxury multifamily. The tenants always pay their rent. It's recession proof. We're giving you our business plan, and in the deal room, you can look at the business plan. Understanding the market, we talked about the market of Dallas, and our submarket is even better than the Dallas-Fort Worth market. So rents rose in the Class A plus market 6% over the last year. But in our area, rents rose 11% in the last year, almost double the rent increase as in the DFW market. Over Austin, way over Houston. And while rents are very flat in Class C, we continue to see the stable rents at $2.86 a foot for that Class A plus. So these are the things that we can go into more deep depth, because I really want to get to listening to Nate about the IRA investment vehicles. You need to assess the purchase price. Now, we purchased for $6.2 million, and over 2 years, we put entitlements, plat, and building permit on, and our property is now worth about $16 million, like Warren said. So we collateralize our partners against the equity that's built in the asset. You're collateralized against the equity. So as we build, then the value of the property goes up and you're collateralized against that equity. Whereas at a Class C property, the profit margins are slim, the rents are flat, and it's a much different story. So also, we want you to ask the hard questions, scrutinize the sponsors or the syndicators. We're owners. We've owned the property since June of 2023. So we're just not in it for that fee. We actually deploy the capital, and this is what we do on a daily basis. Quick property analysis of 22 North. And it was our Austin property, same Class A++ asset class, 30-something tenants, 240 units built on 14 acres. And it sold for a profit of $22 million. And probably the most important thing about our Austin property was it sailed through the pandemic. Our tenants just paid the rent. We didn't have a rent moratorium situation. And so proof and concept, we're leveraging the architectural and the civil from 22 North into our Dallas property of the Prestige. So I'm just going to slide to the end here because I want to be able to look at Nate's slides, and I want to be able to listen to him closely about your investment vehicles. Everybody's financial position is different, and he's going to speak to each and every one of you, I'm sure. And then we'll just take a quick look at the deal room and the educational materials that are available. So Nate, would you be willing to share some of your advanced knowledge?
I'll sure give it a shot.
Thank you.
So hi everybody. My name is Nate Hare. I'm the Vice President of Sales and Strategic Relationships at Directed IRA. We're a licensed trust company out of the state of Arizona. All that means is really we can manage retirement accounts just like a Fidelity or a Charles Schwab. We're a licensed custodian through the Department of Banking of the state of Arizona. Now, what does that mean to you if you have, let's say, an old 401k at a job that you worked at? Maybe it's a current 401k at a job that you're still at. Maybe it's an old 403b, a TRS, a TSP, an IRA. These names I'm bringing up to you are very common, as 70% of Americans have some sort of retirement account. Yet most people don't realize, because it's not taught to us in school and it's not told to us by our advisors, what we can actually invest in with these accounts. And these accounts are not just limited to what most people think they're limited to, which are stocks, bonds, and mutual funds. The investment opportunities inside of a retirement account go well outside of that spectrum of investments. And the reason why I got in this industry is I was recruited by a company in 2012 to teach people how to invest in real estate with a retirement account. Now, they recruited me because I was investing in real estate. I was not investing in real estate in a retirement account. I didn't even know that existed. So when they recruited me, I thought to myself, well, that sounds different. I have a retirement account at Northwestern Mutual. It has a mutual fund in it, but all my knowledge and all the money that I was making was in real estate. I actually didn't make any money in my Northwestern Mutual account. I just thought that that's what you did because that's what my parents told me to do, and that's what my advisor told me to do. So when I finally heard and realized, oh, this is a real thing, you can actually put real estate assets, investment property inside of a retirement account. I thought, well, everybody needs to know how to do this because whether you're a real estate investor or not, I think that you should know what your options are. And that's really all I'm here to teach you guys is what's a self-directed IRA? What can it be invested in? And just let me know if you guys can see my screen or if you can't. But I'm just going to go over a
Showing up
couple
great.
slides.
It's perfect.
Okay.
Perfect, Nate.
I'm just going to
Yep.
talk about what a self-directed IRA is. What can it be invested in? What types of plans can be invested in commercial real estate or real estate in general that you might not realize? And how does the process work? How do you buy real estate in a retirement account versus buying stocks and bonds? So again, this isn't about me, but how I found this, I was an investor. I owned 17 rental properties at a very early age. I worked for a mortgage company. I really liked the finance side of real estate. And in 2012, I went feet first, both feet into the self-directed IRA industry because I just felt like I wish I would have known about this 10 years prior to learning about it. And even today, when I go out and I teach about what these self-directed IRAs are, more and more people are starting to hear about them, but they still don't really know how they work. So I would say 95% of Americans they don't have a self-directed IRA because they don't know what they don't know. So hopefully this short presentation at least gets your brains working a little bit. And me and my cohort, Ashley, who's on, she's one of my senior IRA account executives. We're available to answer questions after this short, presentation. Even though I'm an investor, even though I am the vice president of a company that manages retirement accounts, as a self-directed IRA custodian, we cannot give tax, legal, or investment advice. The thing that's different between us and a Fidelity is we don't sell you the investments. We manage your account, but you tell us what the investment's going to be. And I'll talk a little about how that works and how that's maybe different to what you're used to. But everything that I'm presenting here is just for education purposes only. We always encourage you to do your own due diligence, especially when you are self-directing. So why is this so important? Well, if you look at where most Americans have their money, it's in their retirement account. It's not their bank account. It's not under their bed. It's not buried underneath the house in the backyard. Most people have money in their retirement accounts. In fact, there's well over $40 trillion in US retirement dollars. Now, those consist of 401ks, 403bs, IRAs, TSPs. Most Americans have their money tied up in their retirement account. But most people, just by default, invest their entire retirement in stocks, bonds, mutual funds. I am not against stocks, bonds, and mutual funds as an investment. What I would argue, though, is we have such a large amount of our retirement dollars invested in those assets with no diversification. And when I mean diversification, I am not talking about what your wealth advisor will tell you is diversification, which is you got to have some high risk mutual funds and some medium risk mutual funds and some low risk mutual funds. When you look at the available investment options that are available to you out there, mutual funds is one asset class amongst millions of asset classes. Bonds, stocks are one asset class. In fact, traditional investments are the smallest asset class if you look at what the alternative investment opportunities are. So if you talk to a really good wealth advisor, or if you look at something like a family office, I don't know if you guys are familiar with family offices, but these are, groups of individuals that are probably investing $50 million or more to be classified a family office. When you look at the asset makeup of these ultra wealthy that are investing, very few of their assets that they hold are tied to the stock market. Maybe 30% of their assets are tied to the stock market. They understand, and they've understand for a long period of time, that alternative assets are something that you want to hold in your overall investment makeup. And I'm talking about inside an IRA and outside of an IRA. Because when you look at alternatives, what we call alternatives, alternative investments include things like investment property, a 3-bedroom, 2-bath rental, a small multifamily, a townhome, commercial property, land, cryptocurrency, investments into private businesses not publicly traded, energy, oil and gas, mineral rights, tax lien certificates. These are all available options to you to invest, even with your IRA or your 401k being the investor. The only problem is for most people is Fidelity and Charles Schwab won't hold an alternative investment. Why? They don't sell it. They don't make a commission on it. So they're not going to allow you to hold it in a retirement account with them. See, what Fidelity is they're not only a custodian of retirement accounts, but they're a licensed broker. They're selling investment product. That's how they make their money. When you have an IRA with directed IRA, we're a licensed custodian just like them. We can even hold stocks, bonds, and mutual funds if we chose to. We actually do hold some for some clients. But since we're not a licensed securities broker, since we don't have a menu of investments to sell you, our account agreement with you as a client says we'll hold anything the IRS allows, but you got to tell us what the investment is. We'll go buy it in your retirement account. We'll buy it as the custodian of your retirement account, but you have to tell us what the investment is. And when you look at the tax law, the IRS only prevents us from holding 2 investments in our IRAs or 401ks, life insurance contracts and collectibles. That's it. Those are the only 2 things that the IRS says we don't want that in a retirement account. So as a general rule of thumb, if your IRA if you can buy it, your IRA can be the buyer. If you can hold title to something, your IRA can hold the title. You still have to work through a licensed custodian, though, to buy the investment, because what we essentially have, if you talk about an IRA or 401k, it's a separate entity from you. It's not your money until you take a distribution. But before that point, it's a tax-exempt trust. You have to have a custodian of the trust. You have to tell the custodian to buy the asset, right? So what we do at Directed IRA is we just hold all the stuff Fidelity and Charles Schwab won't, which are alternative investments. Now we have different types of accounts that you can self-direct, I would say. But one thing I want to make clear of, don't get confused when I say self-directed or when anybody says self-directed IRA. Self-direct is just a marketing term. If you have an IRA, let's call it, most people have a rollover IRA, or we call it a traditional IRA. If you have a traditional IRA at Fidelity and you wanted to move some money over to Directed IRA to buy into commercial real estate, you would open a traditional IRA. It's the same type of IRA you have at Fidelity. We just add self-directed in front of it as a marketing term to let you know you have to tell us what the investment is. You have to self-direct this traditional IRA. But at the heart of it, at the core, it's just a traditional IRA. And in fact, we've got 6 accounts that you're probably already familiar with. Traditional IRAs, Roth IRAs, SEP IRAs, even a solo 401k if you're self-employed. And we even have non-retirement accounts that can be self-directed, which would be a self-directed health savings account. I'm sure a lot of people on this program have a health savings account. You might not even have known you can invest it. Yeah, you can invest it. You can even invest it into real estate. And then we even have accounts that you can set up for kids or grandkids that can be invested in real estate, where we call it a Coverdell Education Savings Account. Now, if you back up airplane view, okay, traditional IRA, Roth IRA, SEP IRA, solo 401k, HSA, and ESA, these are all tax-exempt trusts. What I mean by that is the tax law allows us to invest the dollars within these accounts, and the income is not taxed. All the income is tax-exempt. Now, you may pay a tax if you take a distribution from one of the pre-tax accounts, okay, but there are some accounts that you don't even pay taxes on a distribution, which we'll talk a little bit about here, which are like a Roth IRA or a Roth 401k, or the 2 accounts on the right there, the HSA and the ESA. But at the core, these accounts are not taxpayers. the money invested in these accounts grows much faster because there's no tax return these plans file. It's a completely tax exempt account. So if I compared it apples for apples, if you bought Walmart stock in a traditional IRA and you sold Walmart stock and made a healthy profit, all of the profit stays in your IRA and can be reinvested and buy more stock. Now just replace the word stock and put real estate. My traditional IRA can also buy a rental property, sell a rental property, and pay no tax on the capital gains. No tax on the capital gain. No tax on the rental income. We can upgrade that. Let's talk about commercial real estate. Again, all of the income that is generated from an investment owned in a retirement account is not taxed. So you can reinvest the rental income, you can reinvest the gains, you can reinvest the capital gain, and the IRS can't touch you. So these are the 6 plans that you can self-direct. You've got your individual plans, which are an IRA or traditional IRA or Roth IRA. Anybody can have that. Even kids can have these plans as long as they have earned income. If you are self-employed, if you have some Schedule C income or some 1099 income, you can also contribute and self-direct SEP IRAs or one of my favorite accounts on the planet, a solo 401k. If you're self-employed with no employees, make sure you talk to me or Ashley about how that can change your life. And then again, you can self-direct also health savings accounts and educational savings accounts, which are different than the retirement accounts. Normally on a retirement account, you get your maximum tax benefit once you eclipse the age of 59 and a half. That's when your distributions become tax-free and penalty-free. With an HSA and an ESA, you don't have to wait for any age to take the earnings out tax-free and penalty-free. As long as you're taking the earnings out to pay for qualified health expenses for you and your family or qualified education expenses for you and your family. So this goes well outside the range of just retirement accounts, but what the main point is, these accounts don't pay taxes. You can fund your retirement without paying taxes, and you can fund your today's needs when it comes to healthcare and education without paying taxes, provided that you are investing it and growing it. I'll give you a kind of a short this is kind of, in my mind, this is like the end of the road. This is the goal that everybody wants to reach. And again, I wish I was taught this in school at an early age. But we talk about different types of accounts and how they're taxed. And if you compare a traditional IRA to a Roth IRA, these are the easiest ones to compare. Most people have a traditional IRA, whereas when you put money into a traditional IRA, you typically get a tax deduction on the money you put in. But all that does is defer the tax to the future when you take it back out. Now, most in-the-box CPAs will tell you that's what you want because you want to take your deduction in your working years and then defer the tax to your non-working years. Well, my thought was, well, what if I start with $10,000 and make it $1 million? Aren't I still paying more in taxes because I got to pay tax on $1 million? The answer is yes. The reason why, if you talk to most self-directed IRA companies, they always love talking about the Roth IRA is that when you put money in a Roth IRA, the money's already been taxed. They call it after tax. Basically, you just don't get a deduction when you put the money in. But the trade-off is pretty sweet. Since you've already paid taxes on your Roth dollars, that Roth can grow completely tax-free. And when you take the money out after 59 and a half, you pay no taxes on the distributions. So if you're somebody that has an investment opportunity that can start as a small egg and turn into a larger egg, what size bucket would you rather pay taxes on? Obviously, you'd rather pay taxes when it's small versus when it's large. The reason why this is so important when we talk about real estate is real estate has multiple streams of income. Real estate appreciates over time. Real estate also has cash flow. Stocks don't. So when you start looking at real estate as an investment, the fact that it's got multiple streams of income makes it a little easier in my mind to grow a small bucket and make it larger. The other thing with real estate that you can also use in an IRA is we have the ability to use leverage, right? When you buy real estate, typically it's not buying it all cash. You're usually financing money from a bank. The financing increases your cash on cash return, and an IRA can partake in that. So you can essentially take smaller buckets of money through a self-directed IRA borrowed by large assets. And if you're going to use that concept, I think do it in an account that has already been taxed. And I'll give you an example. I've got a client right now that's got real estate assets owned in his self-directed Roth IRA. Okay. Here's the difference. Self-directed Roth IRAs, you pay no tax on distributions once you're 59 and a half and you've had a Roth for 5 years. So just imagine this for a second. He's got real estate assets owned in his Roth IRA through us. They're not owned by him, the taxpayer. They're not owned by his LLC. They're owned by his Roth. Every month, the renters of those properties pay rent to the Roth because that's the owner. It's about $20,000 a month that come from the renters right to the Roth. Since he has tax-free distributions because it's seasoned, he just takes a distribution from those rents of $20,000 and there's no taxes due on that. The next month he takes another 20 grand out. The next month he takes another 20 grand out. So he's taken roughly $240,000 of tax-free, penalty-free distribution from his Roth IRA assets that are real estate. And meanwhile, his Roth continues to grow because the properties appreciate over time. They get higher in value. He's just living tax-free on the rents. He'll never be taxed on those assets ever again. The IRS can't touch him. He's off the grid. And even better, when he dies, that Roth IRA with those real estate assets in there, all that does when he dies, it turns into an inherited Roth IRA, and his beneficiaries, his kids, get to take tax-free distributions for another 10 years. That's how the rich get wealthy, is just by understanding how to put the right types of assets that grow and appreciate in cash flow inside of an account that's not taxed. But in order to do that and own real estate in those types of accounts, you have to work through a company like us that will hold those types of assets. So real quick, and this is kind of where I'll end it and we could take questions. How does it work? Broke it down to really in 3 steps. If you want to start self-directing an IRA or having an IRA that can invest into commercial real estate or alternative assets, the first thing is you just open an account. Okay, we've got a special promo for anybody that wants to open an account. We give you $150 off your first year fee. I always urge people to talk to one of my IRA account executives, tell them the types of plans that you have, ask all the questions you need the answers to, and make sure self-direction is right for you. Now, we'll never sell you an investment, but we'll tell you how the process works. So open an account, and I've got a QR code where you can book account or book a call directly with Ashley. It literally takes 5 minutes online. Give us a copy of your ID, and you've got the account open. From there, you want to fund the account. You can either make a contribution right out of your pocket to fund the account. Most of our clients will do a transfer, an IRA to IRA transfer. If you've got a Roth already at Fidelity, all we need to do is send them a transfer request and they transfer wire the funds over to us. Transfers you can do as many times as you want. They're not even reported to the IRS. The IRS doesn't care how many times you transfer. So transfers are usually the easiest way to get an account funded. And you don't have to close out your brokerage account, by the way. You can have as many IRAs as you want. Most of my clients transfer over, 50 grand or 100 grand, but they leave the rest in their IRA there to sit in the market. They just move over enough to us to invest into the real estate offering that they're looking at. Or if you have an old 401k or an old 403b, or you're leaving a job and you have what's called rollover options, you can roll those employer plans over to an IRA. A little bit different of a process, but those would be the 3 ways you can fund a self-directed IRA: contribution, transfer, and rollover. And once it's open and funded, then you work with our investment team. Okay, this is where it gets a little more hands-on, I would say, because we're not pushing a button and buying a stock. We're buying a real estate asset. We got to work with a title company. There's agents, there's insurance, there's all those things don't disappear. It's just you're working with us to be the buyer on the investment or the investor on the investment. So we've got an investment team that works hand in hand with you. They tell you the documents that we need in order to buy the alternative investment that you're looking at. So open account, fund account, you get your welcome email, and then you invest, or you work through our investment team once you find out what you want to invest in. But I would say start the process early, open and fund an account, at least get the money sitting there. That way, if you know you want to make an investment, you're just waiting for the opportunity, at least it's ready to rock and roll. Because one thing that will screw things up for you is finding the investment first and then trying to open the account and move money afterwards. Because a lot of times we have to wait a little while for Fidelity or Charles Schwab to send the money. And if you're doing all that after you find the investment, sometimes you miss the investment opportunity because they take so long to send the money to us.
Absolutely. I appreciate that so much because it is a little bit complex. We're dealing with IRS tax code as the back end of all of this good stuff, and you all keep up with the code as the IRS changes those regulations. Then you guys keep up with that. You're licensed under the SEC, which also is mandatory for us. I can do accounting at a CPA level, but IRAs are not my specialty. This is a specialty. And then I thought it was also interesting, but I want to go back again to your flat fees because that's why we wanted to work with you all. And you're our preferred vendor for IRAs, Roths, 401ks. So the IRS has this regulation that at the end of the year, you have a fair market value form,
Fair
right?
market value.
Okay, but the IRS requires that we fill that out and file it, but they don't check up on it. It's not like the fair market value police come to your office and say, hey, I want my form. And then also the IRS does not charge more because we have made more money in our account. It's not an IRS thing that some of those other custodians charge more because we've increased the value of our accounts. So I just thought it was really important to have flat fees for our partners.
Well, let me and let me clarify that and step back just a little bit so everybody kind of knows how self-directed custodians charge fees. Now, you got to realize your account at Fidelity at Charles Schwab are not free. People think they're free because I don't get any fees from them because they take it out with the broker fees and the finder fees and the commissions. By the time you get the money, that's why you don't see your account grow. It's like, oh, I thought my stock went up. How come it only went up like this much? It's because they already took their fees out. And oftentimes their fees are 1 to 2% of your account value. Okay. So that's why you don't see the fees. On our end, we don't make commissions on the investment because we're not selling the investment. So we don't hide the fees from you. They're actually on the front end. Now, we only charge fees based on what you need us to do, right? We've got a staff here. We've got a transaction team. We've got people that work in the transfers department, right? All we do is we charge a small fee when you need us to do something. So the first fee, you get $50 to open an account. One-time fee, that's all it takes. $50 and an account is open. Once the account is opened, we have a recurring fee, and this is what DL was talking about, which is a flat fee based on the account. So if you have, let's say, a Roth IRA with us, it's just $495 a year. Doesn't matter how big the assets are. You can hold up to 3 investments in there. Doesn't matter if it's $10 or if it's $10 million. To us, it's $495. It's one account. Some custodians charge you more as the account gets higher in value. And DL kind of pointed out, it's not more work for us. It's more work as we add more investments, true, but we have a $50 processing fee for each investment. So that takes care of that. So those are really only the 3 fees that you see from us: the account opening fee of $50, the investment processing fee of $50, which is when we buy something or sell something. And those are one-time fees. And then the only recurring fee is just your $495 annual account fee for each account. Those fees, by the way, I do not like when people put on the application, take it from my account. Don't tell us to take $400 from your Roth IRA to pay fees. Those fees can be paid outside of an IRA. Throw it on a credit card, get some bonus points on your Alaska airline miles. Do not tell us to take money out of your Roth IRA, tax-free dollars that can no longer grow tax-free, just to pay a fee.
Okay.
But for most custodians, you're going to be about $400, $500 a year. And that's pretty typical. If you're above that, you're probably getting charged too much. But again, the benefit really is the fee is the fee. That just helps us keep the lights on. Your benefit is what are my new investment opportunities, and how much taxes am I saving now by investing my IRA into more tangible investments like real estate? That's really where your mind should be at. And realize, if you really want real diversification, you want to have some private assets and some public assets, not just one or the other. And I'll tell you, it's a kind of funny deal. The reason why they are sticklers on those FMVs now, I've been in the industry when they weren't sticklers on the FMVs. And by the way, FMVs, guys, they're fair market values. For the assets that we hold here, you can't go look them up on CNBC, right? Stocks and bonds, you know exactly what the price is. They post them every day. They run with the market. When we hold the assets we hold, which are real estate assets, notes, investments into private companies, they're not readily assessed value. So the IRS still wants to know, hey, directed IRA, how much assets do you guys have over there? Because we can't see. Back in the day, they didn't even ask. Now they ask because there was a report back in 2020 from Forbes that basically showed that when they did an audit of 27,000 IRAs back in 2016, they found that the higher value IRAs, the ones valued above $5 million or more, had a considerable amount of alternative assets in there. So they were saying, why are all these high dollar IRAs so high and they have so much alternative assets in there? That's the rich knowing where to put their money. Meanwhile, everybody under $5 million, only 2% of every IRA under $5 million had an alternative asset in there. Those numbers were shocking to everybody. That 25% of the assets in a $5 million IRA or higher had alternative assets. Yeah, and we didn't. So, or the small guys didn't. So back then they started.
Here's another question. Here's a different question. We talk about deal doers that may have a 401k from a previous employer. Deal doers can't invest in their own deals. Can you address that point? Because there are certain authorized transactions and unauthorized transactions as we go ahead and wrap up. But deal doers, which some of them will see this webinar, and they may be putting a little bit of money into a single family on their own, but they have an old 401k that they need to put to work. And so they also need to put it into a stellar project like ours, where they don't have to deal with title and they don't have to deal with agents and all that. They want it to be passive with their IRA investment vehicle.
Yeah, so what DL is referring to is what's called a prohibited transaction. Now, the IRS is doesn't really care, as I mentioned, they don't care what the investment is. They do care who was it bought from and who is actively managing the investment. So in the tax code, IRC 4975, if you want to nerd out to some tax code tonight, it lists a list of what they call disqualified people. Disqualified people to an IRA are people that can't transact with the IRA and cannot extend services to that same IRA. Now, for all intents and purposes, I am the main disqualified person to my IRA. That means if I own a property as Nate Hare, I can't sell it to my IRA. It's a conflict of interest. I make the decisions for my IRA. Who's going to tell me no? So they don't want self-dealing between the IRA owner and the IRA. There's also other people that are closely enough related to the IRA owner. They say they don't want them dealing with those people either, which are the IRA owner's spouse, their parents, grandparents, all the way up, and then kids and grandkids and their spouses. It doesn't include brothers, sisters, siblings, aunts, uncles, because in the IRS's mind, who's going to get your assets when you die? It's not going to be your brother. It's going to be your wife. It's not going to be your brother's sister. It's going to be your kids. So if the inheritance of your IRA is going to pass to those people, those are also people that can't transact with that IRA. They can't sell things to that IRA. They can't buy things from that IRA. But the thing that DL is referring to is you can also, those people can also not extend services to the IRA. Put it this way.
But it's a little bit complex, right? This is why we have you as the IRA expert. But basically the IRS doesn't want, they're offering tax deference, or they're offering a tax deferred or tax later. And if it's not an arm's length transaction from yourself, then it's not really a tax deferred available. I think we had a question in that's what was happening. I'm not a Zoom expert, but did we have a question? Maybe Jeff?
Yeah, so if I invest in this deal that Honors Way Group is presenting with my checkbook IRA, and they're getting financing for the project, and I'm listed on title with them, or my company is listed on title with them. Now, aren't I subject to UBIT?
Well,
So
the
if
way
you're-
that the way that we work it, it's not listed as a real estate transaction with directed IRA custodian. It's a business transaction. But the way that we cure that is that we do give you collateral in the property LLC itself based on your private placement memorandum. It's different from every syndicator that's going across your desk, any other sponsor, where they're keeping you in a separate entity at an arm's length. But we put our partners right into the property LLC with Honors Way, so you're collateralized against that equity that we've
Right.
built.
Well, I
And
think
that's what,
I think what
and that's
Jeff,
what I think makes it, isn't that what makes it different though? In those other transactions, that other entity acts as a blocker, where if this one, if I have that equity, if I'm so adjacent to it and you have financing on it, then doesn't that UBIT pass right through to me?
so let me clarify. When an IRA owns a property that's debt leveraged, right? Whether it's a multifamily property or a single family property, okay? In the eyes of the IRS, the IRA didn't make 100% of the investment. It made a percentage of the investment, but a bank came in and financed the rest. So to an IRA, when you have income flowing back to the IRA now becomes a taxpayer on the debt, not the money the IRA put in, on the money that was borrowed. Now, here's the thing. Do not be scared of this so-called tax, which is the UBIT tax you're referring to. Because as soon as an IRA becomes a taxpayer, guess what we get to do to the income to minimize the tax? We get to use all the expenses on the property. We get to use the accelerated depreciation. We get to use all the expenses to whittle down the income. So oftentimes when I've seen this, Jeff, by the time that you throw the income against it, you're talking about the net profit and what it's subject to tax. It's almost minuscule depending on how much debt's on the property. The bigger tax you're trying to avoid is the capital gains. If there's a large capital gain and there's still debt on the property, then sure, the IRA may have to pay a little bit of tax on its capital gain. But here's the cool thing. If the property is owned in a year and a day, you still get long-term capital gains treatment just on the debt piece, not on the entire investment. So it's just on the debt piece. So what your calculation should be, and it shouldn't be, it's just a math problem. Does the debt increase the cash on cash return from my IRA? Because your other alternative is invest all cash, have no debt, but you got to put more money into the property. Oftentimes that reduces your cash on cash return. The debt sometimes helps it. So long story short, the tax is not something to be scared of. It's just an expense that you want to analyze and make sure that, okay, if my IRA has to pay a tax, then I'm getting still this much return. And does that return still outpace what my other investment opportunities in the market? There are other ways you can eliminate the tax too. If you're self-employed, debt leverage properties are not taxed when they're owned in a solo 401k. That's a way around that. And then I think what you referred to, Jeff, is there is an opportunity to do a C Corp blocker. That doesn't really work in real estate. You really don't need it. But again, yes, there could be a tax to an IRA if it's debt leverage property. But if you have a good CPA that can calculate it for you, oftentimes you'll find out, oh, it's not even that big of a deal.
I think that is such a
Understood.
great
Thank you.
question. It's such a great two-part question, right? So Nate addressed the reduction of tax liability issue, and also the cost segregation, where you can take those expenses against a high income, and then the collateral that is available with the Honors Way property. So really advanced question there, Jeff. Was there a follow-on question with that? Are you okay for now?
Neil, I'm afraid
I guess
I have to leave.
Yeah, I'd like to see how the
Okay.
deal is structured in regards to, leverage. What does that really mean? How can we forecast that out? If there's a preferred, a guaranteed preferred return
Mhm.
of, X percentage, how do we,
Up to 3 times.
somehow back, do we need to back 0.5% out for that for our expected UBIT each year?
Yeah, I mean, it really
started
depends.
It's going to be a
and-
little bit more of a detailed question based on your own financial situation. I'm not a CPA, but we can do two things. We can, I think we have an appointment scheduled so that we can talk about the investment, and we'll also do a warm handshake over to Nate's team so that we're working conjointly and can get all of your questions answered if that's okay.
Understood.
Any other questions that we have? Good discussion, good detailed discussion. So thank you for that. I'm going to share my screen briefly because we're running a little long. It's a great conversation. We have a couple resources. Nate gave you some resources on their IRA education, and they do a lot of that great educational aspect on IRA investment vehicles. We have our Honors Way YouTube, which is 150 plus videos, due diligence videos, questions to ask about commercial real estate, because most of the investors are going to be working full-time and passive, and they want to invest and work out of their job, or they're retired and they want to invest and shelter and grow their funds. And that would be the most people that we have usually. So if you go to honorsyoutube.com, then you can subscribe for free, and you can have all of those YouTube videos available on the project updates, the market updates, and commercial real estate education. There is a due diligence course here that will go through how to ask those tough due diligence questions. So I would encourage you to continue your due diligence. The other thing that we have, if you go to Honors deal room, then you can look at the deals. We closed our first fund, raising over $9 million. And we have two funds open. One is a condo project, and one is a vertical income fund. It's a 3-year hold. Both of these are up to 3 times returns, and you get collateral in the property, in the Dallas property. You get collateralized, and that's, Jeff, how your investment is protected. God forbid I graduate to heaven early. What does that day look like? Well, you get your pro rata return. You're made whole by the equity of the property because you're in the property LLC itself. You're not blocked. You're not in a side LP or an LLC. So you're in the property LLC behind the first lien. But remember, we have that equity. Property was purchased for $6 million, is now worth $16 million. You're collateralized against that equity. And then you get your pro rata share of the sale. So as a fiduciary, we make sure that our investors are collateralized and it's a safe investment, plus up to 3 times return. There's not going to be another transaction coming across your desk that is sharing the way that we do and is more profitable the way that we have our structured deals. So with that, I just want to thank you again for your time. And I want to thank Warren for being on to share about the project, and Nate and Ashley for being on. And I look forward to continuing to work with you. I know that we've brought some folks to you and a warm handshake, and that has been great. And did you have any parting words, my friend?
I'll just say I appreciate everybody's time. I hope it just got people thinking, maybe about what their opportunities are. And
Thank you so much. Thanks, everybody.
After a lifetime of hard work and dedication, it's time to enjoy the fruits of your labor. As you enter into retirement, securing your nest egg and preserving your financial future becomes paramount. Not only sheltering, but safely multiplying your returns in a hard asset, which does not walk away. You can drive by at any time. Introducing The Prestige, your trustworthy, vetted partner in commercial real estate investing. We understand that you seek less risk, financial security, and a reliable source of income. With over 400 years of combined experience and proven track records, the Prestige is your beacon of trust. We specialize in providing safe and secure investment opportunities tailored to your retirement goals. We know that you need to rely on experts to navigate the complexities of the market. That's why our team of seasoned experts is here to guide you every step of the way. Our collateral contracts have been approved 10 plus times by Quest IRA, which is under the SEC. Here are just a few of our client testimonials. Wow, DL, this is so exciting. I'm so happy for you and for us. Very exciting. Love the floor plans. We've got our distribution pending in our bank account. Thanks so much, DL. DL, we can set our watch to your distributions. Never missed a payment. Don't compromise on your retirement dreams. Visit The Prestige at mayhill.com today for our current and rare investment opportunities. And let us utilize our 400 plus years of experience to safeguard your nest egg and provide you with a secure investment in a low yield market. We are owner operators with daily hands-on on-site responsibilities. We are not syndicators. DL began in commercial real estate in 2005 and is one of the top seasoned leaders in investing and developing in Southern California and Dallas, Texas. And there is no slowing down. The Prestige, your trusted partner in commercial real estate investing for retirees.